Hi, this is ET now, and you've tuned into the newsroom. I caught up with Shashank Srivastava of Maruti to understand the demand trends. He's also sounded off that auto recovery could still be some distance away. Let's listen into an excerpt of that chat.
On the retail side also, the demand has been pretty good. But of course, if you compare these retails for December, which we just saw this last December, definitely it is not at the same record levels that we saw year before last. So year before last in the industry, the total retails were about 382,000. Last year, they were about 370,000. And we are still getting figures from all the other manufacturers. So it should be a little less than that this year. But I think this year is a unique year, a unique December, other than, different from the earlier Decembers, because the availability of vehicles in stock across the industry has been a constraint for the retail for the month of December.
So how are you working to ease the supply chain issues? And if you could also tell us, are you facing any concerns on your vendors front? Because yes, I know that Maruti sources most of its parts locally, but down the supply chain, of course, there might be some parts which might be imported from different parts of the world. And given the freight rates, given the container shortage, is there any concern on that front?
So while I may not be the best person to answer this, the supply chain guys probably have a much better details. But so far, we are going okay with the supply on the supply front. However, overall, yes, as I said, when we talk of vehicle availability, there we have been working at peak productions for the last couple of months, and still the stocks are low. And I must add a caveat here, because this gives a sense that there is a great jump in the industry. There is a bounce back, definitely, and last couple of months have been really good. But if you take a look, if you just look back and see that the April to December figure, we are still negative 18% over last year, and last year itself was about 17-18% less than the previous year. So when you compare with the year 2 years back, then the industry this year is almost 33% down. And that, I think, is what people will start looking at in a few days' time. Because at the moment, we are all looking at normalcy returning to the industry. So the last 4 or 5 months, we have seen progressively, getting back to normalcy. But once we achieve that, then and take a look back, then we will realize that we still got a long way to go to even reach the levels of the year before last. In fact, I will go further, Karunya, that if you see the CAGRs of previous 5 years, so 2015 to 2020, the CAGR growth rate in the auto industry is just 6 or 7%, compared with 5.9 in the period 2010-15, and compared with 12.9, which was in the period 2005 to 2010. So I think we have to take a look at that and see that the broader picture may not be as rosy as the past few months data seem to be suggesting.
That's exactly what I was coming to, Mr. Srivastav, because,
yes.
You have seen multiple down cycles in the past as well.
Yes,
and we also have been talking very often to OEMs and to voices from Motown to understand by when will things kick back to levels that we saw last in 2017, 18 and early 19. So tell us, what is so typical or so different in this particular down cycle? Why is it that the CAGR has dropped to 1.3% for the last 5 years compared to a 5.9 in 2010 to 2015 and 12.9 to 2005 to 2010?
I think one of the big differences which we see is that the cost of acquisition itself has gone up for various reasons. One, of course, is the taxation has gone up substantially. You see in some parts of the country, the road tax is extremely high, as also we saw an increase in the insurance taxes. we also see that the regulatory requirement in order to meet the regulatory requirement, both on the emission front when we shifted from BS4 to BS6 in 2000 last year, at that time, as also the new offset norms, I think much of the cost which has gone into meeting these regulatory requirements also. So these two factors have increased the cost of acquisition. And in a country like ours, where the motorization is still at a very low level, we are just around 25 per thousand, and we have almost 50% first-time buyers. In other words, people where the income levels are not so large, who are just getting into the motorization and the usage of motors. I think the cost of acquisition plays a very, very important role. And that is where I think it has been the real source of the falling CAGR that we just mentioned.
How can that concern be addressed? Are there any suggestions that industry top bosses have made to the policy makers perhaps? Right now we're even staring at petrol and diesel at an all-time high, so that adds to sort of the entire cost of acquisition burden as well. So any recommendations or any requests made to the policy makers?
Yes, we have made suggestions. Of course, it's been a long-term suggestion that the GST rates have to be rationalized. But we do understand that given the unprecedented situation, the government has to look at a much broader picture. They have to look at the other social sectors, other industries as well. So maybe a GST reduction, although would be, I'm sure would be welcomed by the industry, may not be always possible, because that is something which the government has to look at, and they are the best judge of whether to have that reduction or not. But given that, we can even have a demand creation. On the demand creation side, industry has been giving suggestions on an incentive-based scrappage policy, for example, which can lower the import bill, because the new vehicles will be more fuel efficient. It will also spur demand and therefore help the industry. It will also help in the pollution being less, because the newer vehicles are much less polluting. So that is one suggestion. The second suggestion is, we have just come out of a BS4 to BS6 transition last year. That has also increased substantially the cost of acquisition. And going forward, we have two major regulations coming up: the CAFE 2, which is applicable from 22 April, and the BS6 phase 2, which will be the RD, which will be based, which will start from April 2023. So coming back from the BS4 to BS6, plus because of the pandemic, we have seen an unprecedented lost 1 year, almost a loss of 1 year, both in development as well as in terms of the demand patterns. Therefore, the industry has been suggesting that maybe if we go by the original schedule of the CAFE and the RD norms, it might actually cause another burden of investment, which would be reflected in increased prices ultimately, which would further dampen the demand. And therefore, it is probably more prudent to shift the date of implementation of the CAFE 2 and the RD norms to April 2024. That has been the other suggestion from the industry.
While UV volumes and UV segment as a whole is garnering a lot of attention, competitive intensity has really gone up there. You've got a great lineup as far as the compact SUV space is concerned, but mid SUV, upper end of the SUV bracket is where, which has really grown in size, and that's where even a lot of preference for diesel comes in.
Yes.
What is the strategy for you to perhaps grab a higher share in this space than what you already have?
Yeah, so I mean, that's a very, again, a very, very important and pertinent question. And if you ask me, that's what high-powered petrol engine that we have. But yes, for the mid SUV, we have the S-Cross, which we launched recently with the 1.5-liter BS6 petrol engine. We would definitely like to maximize sales for the S-Cross in this segment. Going forward, of course, we will be looking and watching this segment very carefully. to see if it requires any support as far as products are concerned. But you have hit the nail actually. So if you look at the market shares, for example, for Maruti Suzuki, our market share has gone up in every segment. So our market share in the hatch segment is quite high. It's about 65-66%. It's also quite high in the MPV segment, which is about 58-59%. In vans, we are almost 95-97% of the market. It is this SUV segment which we need to look at closely. And I have no qualms in admitting that at that moment seems to be a slightly weak point for us, and we are seeing how to address that situation.
Another space, Mr. Srivastava, where a lot of disruption and a lot of innovation is happening is the electric vehicle space. What we understand from reports is that WagonR electric launch has been shelved. And okay, aside from that, if you could also tell us, firstly, if this is true, and secondly, what is the kind of innovation or work that's underway for sort of taking on the EV challenge?
Yeah, so again, forward guidance on product, it may be difficult for me to give here. But as regards EVs, I can give you a general thought process, which is that at the moment, the battery technology is very, very expensive, which makes the cost of acquisition of the electric vehicles very, very high. And that is one of the reasons why worldwide the EV percentage hasn't really gone up. And we need to see how to address that. Second is that the charging infrastructure in India is still not developed. And third is that there is a range anxiety which consumers have, which prevent consumers from actually going in large volumes for EVs at the moment in India.
Right. Just before we wrap up, Mr. Srivastava, we started talking about retail demand and supply issues and how there's a shortage still in the system despite a strong resurgence in demand. ET now had picked up from its sources that Maruti is looking at a 2 million mark for production in 2021. If you could confirm that to us, or if you could just, if not give us the numbers, but tell us about the output and how you plan to scale it up this year.
Yeah, so listen, we have to work on many scenarios, and that's how companies normally operate. So you have sometimes a very optimistic scenario which you need to prepare for capacity planning, etc. Then there are some other scenarios, maybe what is more realistic, and some which might be used for your expense planning, which might be a slightly lower number. So I don't know where the ET now sources got those figures, but it's possible that we are working on different scenarios, and that is how we do every year. We work on different scenarios because in the current environment of business, there will be a lot of uncertainty, a lot of volatility. VUCA, as the term goes, there will be a lot of that uncertainty, and we need to work on different scenarios. That's what we are working for as far as next year is concerned.